Okay, so we'll get started on chapter 13. So mathematically, there's a lot of review from Finance 330, and mathematically, it is a simple chapter. However, there's a lot of details, okay, that will help you to execute the actual calculation when everything's applied to the real world scenario. Okay, so what are we going to talk about in chapter 13? Let's start with what we should have learned in the past, okay, from this course. So earlier chapters on capital budgeting focus on the appropriate size and timing of cash flows. So we have been spending a lot of time talking about how to make capital budgeting decisions, right? So in chapter 5, we talked about or reviewed how to use net present value rule or IRR rule or payback rule to make. Oh, okay. Come in. Sorry, it's loud outside. That's why I closed the door. Okay, so we reviewed how to make capital budgeting rule to make accept or reject decision, right? So capital budgeting decision and net working capital decision, the difference that both are investment decisions, but if you're trying to evaluate a long-term project, long-term investment project, that by definition is a capital budgeting decision. But if you're trying to evaluate a short-term investment project, right, that's something that will last for 1 year or less, that will be a net working capital decision, okay, which is a much easier decision. Well, capital budgeting decision, the long-term decision is much more complicated. And we have spent a lot of time estimating those cash flows in chapters 6 and 7, okay? So just to have a brief review, for example, we learned that to decide whether you should accept or reject the project, the best rule of all is the net present value rule. And how do we calculate net present value? We start with cash flow 0, which is almost always a cash outflow. Then we add a cash flow 1. We're going to convert all of the cash flows back to present value. So to discount cash flow 1 back to present value, we discount it by 1 plus R for just 1 period. Now we add cash flow 2 to it. To convert cash flow 2 to present value, we discount it by 2 periods. So we divide it by 1 plus R to the power of 2. I will continue with cash flow 3, discounted by 3 periods, all the way until the end of the project. So if you anticipate the project to last for, let's say 10 years, okay? Let's say that the T equals to 10, that's your last cash flow. Then you need to include all of the future cash flows until the end of the project. In this case, if you anticipate the project to last for 10 years, you need to include all the cash flows from cash flow 0 to cash flow 10, okay? So that's how you decide whether you should accept a project or reject it, right? You will only accept if the NPV or net present value is positive. So in chapters 6 and 7, we spent a lot of time estimating those cash flows. They are also known as the cash flows from assets. And now in chapter 13, what are we gonna do? We are going to talk about how to estimate the R, the required return that should be used for the project, okay? So that we'll complete the capital budgeting decision. So this chapter discusses the appropriate discount rate when cash flows are risky. And what else have we also learned? Okay, so we have learned or reviewed that variance and standard deviation measure total risk, right? There are different kinds of risk. So we use different statistics to measure different risks. To measure total risk, we can use either variance or standard deviation. Well, standard deviation is preferred. Right? Standard deviation is just the square root of the variance. So why do we say either one of the two will be fine? Well, because the standard deviation is just the square root of the variance, right? So if asset A turns out to have higher variance than B, in other words, we can say that A has higher total risk than B. Well, if it has higher variance, when you take the square root of that variance, A will still have higher standard deviation than B, okay? That's why we say that you can use either variance or standard deviation. Both will help you to reach the same conclusion. If A has higher variance than B, it will also have higher standard deviation than B, okay? Either way, your conclusion is that A has higher total risk than B. Now, how do we measure systematic risk? We use kappa and beta, not just any beta, okay? So a lot of time, at least in introductory textbooks, we simply just use the word beta, to measure systematic risk. But the truth is that there are so many models out there. Many models have beta in them. While the beta across different models are not calculated the same way. Okay, cap and beta is calculated very uniquely. And in chapter 11, how do we calculate the cap and beta? So just so we're clear, beta of a company, let's say for company A, is calculated by using a fraction. The numerator is covariance between this asset A and the market portfolio. A stands for the asset, M stands for the market portfolio, and we'll divide that by the variance of the market portfolio. This is M, okay? Variance of the market portfolio. So again, the higher number always means higher risk. Okay, so if you find asset A has higher cap and beta than B, then we can say that A has higher systematic risk than B. Okay, and we also briefly mentioned that whichever asset that has higher total risk, it doesn't necessarily mean that you should also have higher systematic risk. Okay, so just because A has higher total risk than B, it doesn't mean that you will also have higher systematic risk than B. It could be true, but it may not be true. Okay, so these risks are not correlated. Okay, total risk and systematic risk are not correlated. Just because A has higher total risk than B, it doesn't mean that A will necessarily also have higher systematic risk than B. Okay, so those are what we should have learned. Then what are we going to talk about in this chapter? As what we briefly mentioned, we're going to talk about how to estimate the required rate of return when making a capital budgeting decision. Okay, we're trying to estimate the R in the denominator. So before we do that, we need to first of all know how to calculate our weighted average cost of capital. So using the initials, it is called WACC, okay? Weighted average cost of capital. Now to calculate a weighted average cost of capital for your corporation, we need to find three other costs. We'll have cost of equity, we'll have cost of preferred stock, and we also need to know what is after-tax cost of debt, okay? Depending on which textbooks that's being used, the notations may look a little different, okay? But we typically use either RE or RS to represent cost of equity. E stands for equity, S just means stock, okay? Common stock specifically. So what is cost of equity capital? It is the required return that common stockholders demand. Cost of equity is the required return that common stockholders demand. So since it is the rate of return that they demand, that's the rate of return you have to pay them in order to keep them happy. If they are not happy, there are plenty of companies that also have stock outstanding. So what they can do is they can simply dump your stock and reinvest the money elsewhere. Okay. So cost of equity is the required return that common stockholders demand. So using that exact same logic, then we know what cost of preferred stock and cost of debt are. Okay. So cost of preferred stock, we use RP, where P represents the preferred stock. Okay. So what is cost of preferred stock? It will be the required return that preferred stockholders demand. And bringing back that risk return trade-off theory that you guys have seen or heard many, many times in the past, right? So it is only human nature that we do not like risk. And therefore, in order for us to take on riskier investment, you have to pay us higher rate of return. So the required rate of return is going to have a positive relationship with the perceived level of the risk. Okay, as the risk level of this investment increases, while all else being equal, the investors will increase their required rate of return. Okay. Then what is cost of debt? It will be the required return demanded by bondholders. Okay. Required return that bondholders demand. Okay, we use RD typically to represent cost of debt. Okay, the D is the initial of debt. But since when a corporation borrows money, it is obligated to pay interest on the amount borrowed, right? But based on the accounting rule, when a corporation or anybody pays interest on the amount borrowed, that interest expense is tax deductible. Because of that, what is relevant here is that we need to take taxes into consideration and calculate after-tax cost of debt. Then use the after-tax cost of debt along with the cost of equity and cost of preferred stock to calculate the WACC, okay? So once we have calculated the cost of debt, how do we convert the cost of debt into the after-tax cost of debt? It will be, this should be review, okay? Cost of debt multiplied by 1 minus the tax rate. Okay, so the conversion is very simple. Okay, mathematically, okay, everything here should be reviewed, okay, because you have learned all that in Finance 330. Okay, and if you don't remember much, that's fine. Okay, the math portion is pretty simple, but it is other concept that we need to fill in so that we can complete the case analysis. Okay, so let me get some space here. Okay, so there are a few other things that we are also going to talk about, okay? So we're going to talk about not just how to calculate WACC. You already learned that in Finance 330. So once you have calculated the WACC of your corporation, should we use the WACC directly into here as the R when we make capital budgeting decision? The answer is no, okay? In the real world scenario, we need to think a little deeper, okay? So the truth is that if you remember, we're trying to make a capital budgeting decision, right? So we're trying to decide, should we accept or reject this project that is currently being presented to us? So what we need to do is to compare the risk level of this new project with the current level of the corporation. So if this new project turns out to be riskier than our company's current operation, then it will be inappropriate to use the WACC directly into here to evaluate a new project. Okay, because again, that risk return trade-off theory tells us that riskier projects needs to have higher required rate of return. Okay, so if the new project does not have the same level of risk as the company's existing operation, once you have calculated this WACC, you need to make some sort of adjustment, okay? So if the project is riskier, then you need to increase the WACC, okay? Start with the WACC and add some percentages to it. If the project turns out to be less risky, then you need to start with the WACC and subtract a few percentage points from it. Okay, so we'll talk about how to do that. But other than that, we'll also talk about the problems of CAPM beta. Okay, so CAPM was developed in the late 50s. In the first 30 years, okay, it was viewed as the best model ever. It's the #1 model. It's still the most popular model that's being used in the corporate world when it comes to estimating cost of equity. However, ever since the beginning of 1990s, pretty much every study that examined the efficiency of CAPM beta will tell you that it has extremely low adjusted R square, somewhere between 3 to 9%, which means that it's only reliable 3 to 9% of the time. That's extremely low. However, it is still the most popular model in the corporate world because it is, in fact, the easiest. And it makes a lot of sense. And plus, that it really doesn't require much of any math skills to know how to apply the CAPM model, okay, CAPM equation. So you still have to know CAPM very well, okay. So we'll talk about the advantages or strengths and weaknesses of CAPM beta, okay. Then we'll also talk about, well, what if your company doesn't have enough data for the analysis, then what do you need to do? How do you make a capital budgeting decision? So there are a lot of things, a lot of details that we'll talk about in this chapter so that it will help us to complete the case analysis. Okay, so let's get started. So let's start with cost of equity, okay? cost of equity. So remember what we're doing right now, okay? We're trying to, first of all, review how to calculate weighted average cost of capital. But in order to do that, we need to know how to calculate cost of equity, cost of preferred stock, and also after-tax cost of debt. Okay, so let's start with the cost of equity. And we can use either RE or RS to represent cost of equity, depending on which textbooks that you use. Okay, so cost of equity can be estimated, and those three that are listed here are the three most popular models. Okay, CAPM, literally the easiest model that you can possibly find. And I went ahead, copy and pasted the same equation from the previous chapter. Again, different textbooks may use slightly different notations, okay? So that same CAPM equation may look like this, okay? The R bar may be rewritten as your expected return for the assets, let's say for asset I, okay, just to keep the same notation. Risk-free rate, you may have big R, you may have a little r, it doesn't matter. Plus beta, if this is, we're trying to find the expected return for asset I, we need to plug in beta for that asset I, okay? Then we multiply it by the market risk premium. This is the market risk premium, okay? And your market risk premium sometimes is notated as the expected return of the market, the minus the risk-free rate. I'm running out of space, so bear with me, okay? So this is expected return of the market portfolio minus the RF, which is the risk-free rate. Okay, so the application is very, very simple. And dividend models, we have also reviewed the three dividend models, right, in the previous chapters. So we have zero growth model, we have constant growth model, and we also have variable growth model. Okay, we just have to rearrange the equations. Rather than solving for the P0, we're rearranging the equations to solve for the R instead, okay? Now the market model, you may or may not have learned it before, but I would say if you're a finance major, chances are you have seen it before. So the market model looks a little bit like the CAPM equation, but it requires you to have some basic understanding of regression analysis. So if you have had one statistic course before, you should be able to do it. So basically the market model says that the return of an asset, okay, that's your y-axis, is equal to, we have an intercept. So it's going to look very much like the CAPM equation, but the intercept is not the risk-free rate. The intercept is alpha, which is a regression output that the app will provide you with. Okay, so plus we also have a beta, but this is a different beta. So market models beta and CAPM beta, they are two different things. Okay, so this is beta for that asset A. Okay. Then rather than multiply the beta by the market risk premium, we multiply it by RM, which is the return of the market portfolio. So basically, in the regression, your return of the market portfolio is your x-axis. While the return of your company, this is your y-axis. Okay. Basically, you're trying to use the return of the market portfolio to predict what the return of your company is. Okay, so regress your y-axis on your x-axis, then your regression analysis will provide you with the alpha and beta as the regression outputs. That you can plug them into here, multiply by the RM to find your required real return. Okay, so in the case analysis, we're actually going to do that. Okay. But you can see the resemblance between the market model and the CAPM equation. They look very much alike, but they are not the same thing. Okay, CAPM does not require any regression at all. And just so we're clear, so earlier we briefly reviewed how to estimate or calculate the beta, CAPM beta, right? So that is calculated as covariance between the asset, let's say asset I, okay, just to keep the same notation, and the market portfolio divided by the variance, okay, which is sigma square of the market portfolio. So this is how you calculate CAPM beta. But in any regression analysis, the beta will be calculated this way. So you will still have the same, okay, sorry, I'm at that spot that the screen doesn't work, so I'm going to move to the left, okay. In any regression analysis, the beta or coefficient will be calculated. It still has the same numerator. Okay, so since I'm using A here, I'm going to use A here. Okay, so covariance between asset A and the market portfolio. So the same numerator, but the denominator is different. The denominator, rather than having the variance of the market portfolio, we now have standard deviation of the asset multiplied by the standard deviation of the market portfolio. Okay, so you can see that the beta calculations are not the same. Okay, so that's why I always emphasize this. Which statistics can measure systematic risk? It's not just any beta. Okay, only CAPM beta measures systematic risk. Market model beta or all of the beta from any regression analysis, they do not measure systematic risk. Okay, they are not calculated the same way. But because they have the same numerator, okay, so your betas may look somewhat similar, but they are not the same thing. Okay, so these three models are actually the easiest cost of equity models that exist. Okay, there are many much more complicated models out there. Trying to delete it. Okay, there we go. Okay, so for example, okay, so just slightly more complicated, maybe just 4 or 5 times more complicated. We also have 3-factor or 4-factor or even 5-factor models. So maybe a couple of statistical analysis, statistic classes that will give you enough mathematical background to actually apply those factor models. Okay, just a few times more complicated than CAPM, but not so much that's painful. Now, starting in the late 70s, for a couple of decades, there was factor analysis that was very popular. Okay, factor analysis. So the factor analysis is also relatively easy to apply. Okay, so a couple of statistical classes is enough of mathematical background to apply those models. But there are some models that allow the beta to change through time. Those models are extremely painful. We'll have time series model, Garch, Arch models. They are extremely painful. Okay, but what is mentioned here, they are not so painful. Now with factor analysis, we may start with, let's say 15 or 20 variables that we believe can explain the cost of equity. But once the computer basically goes through some analysis to group multiple variables into factors. So you may start with 20 different variables, but at the end of the factor analysis, that 20 variables may turn into 4 factors or 5 factors. Okay, some of you may have had statistics that learn how to perform factor analysis, but that's not something we're going to discuss in here. Okay, we don't have the time for that. Okay, so let's start with the CAPM. Okay, the application is very simple. Okay. So cost of equity capital, required return demanded by the stockholders. To be specific, this is just common stockholders, okay? So ways to find cost of equity, we can use CAPM, we can use one of the 3 dividend models, we can use market model. So those are the easiest cost of equity models, okay? So let's start with CAPM since it is the easiest of all. And we have reviewed how to calculate CAPM beta. Okay, just so we're clear, this is in the numerator. This is covariance between the asset I and the market portfolio divided by, in the denominator, we'll have variance of the market portfolio. Okay, this is not variance times RM. This is variance of the market portfolio, just so we're clear. And now what variables do we need when we want to apply the CAPM? Well, you simply look at the equation. If I go back to 2 slides earlier, this is the CAPM equation, right? So if we're trying to estimate cost of equity, which is this term here on the left-hand side, then we just need to make sure to find the inputs for the right-hand side. So what do we need to find? We need to find the risk-free rate. We need to calculate the beta for the assets, okay? We need to calculate, well, we need to find the RM, the return of the market portfolio. So these 3 are the inputs that we will need in order to estimate the cost of equity on the left-hand side of the equation. Okay, so let's start with a very, very simple example. Okay, so suppose the stock of Stansfeld Field Enterprises has a beta of 1.5. So this CAPM beta has been calculated for us already. Okay, this is our beta. And in this case, this is a simplified scenario because we are told that the firm is a 100% equity financed. So when we say equity, to be specific, we mean just common stock, okay, excluding preferred stock. So if this is a company that only has common stock outstanding, it means that it has no preferred stock, it has no bonds, no debt outstanding. That tells us that once you find what the cost of equity is, that's also the cost of capital for your corporation. Since there's no cost of debt, there's no cost of preferred stock that we need to worry about because those assets don't exist. Okay, when the company is a 100% equity finance company, it only has common stock outstanding. Okay, with no preferred stock and no debt. Okay, so assuming risk-free rate of 3%, this is the RF, and the market risk premium of 7%. This is, I'm going to use the initials, okay, market risk premium. What is the appropriate discount rate for an expansion of this firm? So over here, this question does not say specifically use CAPM to calculate your cost of equity, but based on the information that you are given, when the beta is given to us, it should be a really good hint that you have to apply CAPM, okay? So here's the CAPM equation, so let's just plug in the numbers. Our RF risk-free rate is 3%. Our beta is 1.5. Now, the market risk premium is 7%. Where is the market risk premium in the equation? It is this term in the parentheses. Okay, this is the market risk premium. So read the question carefully. Okay, the application is very simple. But in this case, the authors give you the market risk premium, which is the term in the red circle. While other times, they may only give you this, the return of the market portfolio. So you need to make sure to read the question carefully so that you will plug in the numbers correctly. Okay. Beyond that, this application is very simple. So it'd be 1.5 beta times market risk premium of 0.07. Then you should have cost of equity that is 13.5%. Okay. Now, since we are told here that the company is a 100% equity financed firm, therefore, once we know what cost of equity is, we can go ahead and use this to evaluate the new project. So let's say that we are evaluating 3 potential projects. Well, these 3 projects are mutually, oh no, they are independent. Okay, they are independent. So we have 3 projects, A, B, and C. Well, 3 projects are independent, which means what? Accepting A has nothing to do with any of the other projects. So that implies if I want to decide whether I should accept A or not, I will only look at it while assuming all of the other projects don't exist. Okay. So our calculation based on CAPM, it has given us a cost of equity that is 13.5%. So we're going to use that as our required return to calculate the net present value and IRR. Okay, so I'm only going to do this for project A. Okay. So here we're told that each project costs $100. So this is our cash flow 0. And it's a cost, so it's a cash outflow. Okay. And those are the cash flow 1 here, okay? And each project only lasts for 1 year because there's no information regarding cash flow 2 or cash flow 3, right? It says cash flow for next year. So this is cash flow 1. So to calculate for the NPV, we'll press cash flow, second clear work. Cash flow 0, 100 negative. Cash flow 1 is the 125. And it occurs only 1 time. Okay, there's no cash flow 2, no cash flow 3, and that's all the relevant cash flows there is. So to find NPV, we'll have to find our required return. And what is it? Based on our CAPM equation calculation, we know that our R should be 13.5%. So that is our discount rate or required return. Then press down arrow and compute. Okay, our NPV is positive $10.13. So it's this number here. It is positive, right? So based on that, we will accept project A. Now to calculate for the IRR, we have already entered all of the relevant cash flows, so we don't need to re-enter them. We simply press IRR, then press compute. So our internal rate of return for project A is 25%, and that also has been calculated for us. Okay. So using the net present value rule, since NPV is positive, we will accept project A. Now using the IRR rule, how do we make capital budgeting decision by using the IRR rule? It says that we will accept, well, accept if IRR is greater than our required return. So our required return is 13.5%, while IRR is 25%. Guess what? IRR is in fact higher than the required rate of return of 13.5%. So your IRR rule still tells us to accept project A. Okay. Now for project B, I'm not going to calculate them because they actually have been calculated. The net present value for B is 0, for C is negative. Okay, so we should reject projects B and C. Okay, but only accept A, because only A gives us a positive NPV. So this was a very simplified, extremely simplified numerical example. Okay, so let's talk a little bit more about CAPM. So we know that the application is very simple, but let's talk about strength and weaknesses or problems with CAPM beta. Okay. So what we have found is that a company's beta is often very volatile through time. Volatile, we're saying this. So let me show you this with a timeline. Okay. So typically, the most well accepted approach is that we'll use historical return, monthly return information to calculate CAPM beta. So let's say the most recent year is 2020, then last year 2019, 2018, 2017, 2016, 15, 14, 13, and 2012. Okay, so what we have found is that whether we use the most recent 4 years worth of historical return information to calculate beta, or this 4 years, or this 4 years, or this 4 years, okay? So what we find is that the beta, okay, tends to be very volatile. And sometimes we can find reason to explain why the beta of the same company changes, while other times we simply cannot explain why. So the first bullet statement, those are the reasons that make sense. Okay, well, we have found that the company's beta often change when the industry of the company changes, right? So if your company changes from a dishware company into a fiber optic company, naturally the industry has changed, right? So in that case, when the business nature or risk changes, the risk return, everything should change as well. So when the company changes its industry, then systematic risk changes. That's not too surprising. Okay, so we have also found that when the company's financial leverage changes, the beta also changes. So the financial leverage is often measured by debt to equity ratio. Okay, market value of debt divided by market value of equity. Okay, this is called the debt to equity ratio. Okay, higher debt to equity means what? Higher leverage. Okay, higher debt to equity ratio means higher financial leverage. So what have we found about financial leverage? So what we know for sure is that when financial leverage increases, the company's default risk also increases. Right? When a company borrows money, whether it makes enough money to pay for the interest or its debt obligation this year, it doesn't matter. Either way, whether you make money or not, you are obligated to pay. Okay, if you fail to pay or your promised interest or whatever your payment obligation is, then you have defaulted on your creditors. Okay, so the higher debt that the company has, the higher default risk that the company also has. Okay. So when a company's financial leverage goes up, it's natural that the default risk goes up, and therefore it may impact the systematic risk of the corporation. Okay, so that's understandable. Okay, that's understandable. We also find that sometimes when regulation changes, right, it affects the risk level of the corporation, or the product line changes, well, the risk and return nature of the company should also change. That's not surprise. Okay, those are not surprising reasons. Okay, so those are the reasons that make sense. Okay, that can cause the beta of the company to change. Okay, so we're not surprised with what is said in this particular bullet statement. However, what we have problem making sense is the next one that is highlighted in red. It says that a lot of time we find that when the business nature does not change at all, the economic condition of the company remains pretty much stable, pretty much the same across the past 6-7 years. And for the financial leverage, everything remains the same, but somehow the company's beta still change. Okay, and we can't explain that. Okay, when everything else remains the same, but somehow when you use the most recent 4 years, or you just move it, but shift it by another 1 year, or shift it by another 1 year, you're always using the 4-year monthly return information, but somehow the beta of the same company changes. Okay, well, we absolutely can't find any reason to explain that. Okay, so that's one of the problems of CAPM. So CAPM beta can be volatile, and we can't always figure out why. And we also have found that, for example, the most common approach is to use the most recent 4-year return information. And most people agree that the monthly return information is the best. Okay, but we have also tried to calculate CAPM by using, for example, weekly return information, daily return information, and within the same sample period for the same company, the beta can change drastically as well. Okay, and we also don't have reasons to explain that. Okay, whether you use monthly return or weekly return or daily return for the same company for the same time period, the beta can change significantly as well. Okay. So since CAPM beta can be volatile, how do we fix the problem? Okay, so one common approach is that we can use industry beta as your company's beta to estimate the cost of equity when you apply CAPM equation. Okay, so that's because our industry beta has been found to be a lot more stable through time. Okay, through time. So how do we find the industry beta? First of all, you need to find all of the major competitors in the same industry. Okay, those are called your comparable firms. Find all of your major competitors in the same industry. Calculate the CAPM beta for each one of those companies. Then from the group of CAPM betas, find the simple average. Okay, so that's the average beta of all of the comparable firms in the same industry. So this process is a little time consuming. Okay, it's a little time consuming. However, if you're lucky, if all of those measured competitors in the same industry are large corporations, you may be able to obtain CAPM beta by going through some public information. Okay, chances are, if those companies are large corporations, you will have many financial analysts that follow those corporations, and therefore you already be able to find those calculated CAPM beta that are available, okay, as public information. And then you can save a lot of time, okay, a lot of time. So okay, there we go. So we can see here now. Okay, so if you believe that the operations of the company are similar to the operations of the rest of the industry, then it is appropriate to use your industry beta and plug in that industry beta as your company beta into the CAPM equation. Okay. But in the case analysis, we're going to see a different scenario. What we're going to find is that our company is a relatively young company that just had the IPO 6 months ago. Okay, so we simply don't have enough historical return information to calculate the CAPM beta for our own company. So in our case analysis, we'll have to find ways to identify. In this case, we're only going to identify one comparable firm. okay, from a group of major competitors in the same industry. So find a comparable firm that resembles our company the most, then calculate the beta of that comparable firm. Then use that capital and beta to calculate cost of equity. Okay, so that's what we're going to do in the case analysis. Okay, so the other variable, the risk-free rate. So just to briefly recap, the CAPM equation looks like this, right? So we have risk-free rate that needs to be applied. Okay. Now, in most classes, at least on exams, to make our lives easier, we simply just use 1 year T-bill rate as the risk-free rate in most cases. However, that is overly simplification, okay, overly simplified. So let's read this together. So treasury securities are close proxies for the risk-free rate. And we know that when you see the word treasury, it implies that it is debt issued by our federal government, right? So whether it is short-term debt or long-term debt issued by the federal government, it depends if we have T-bills or T-notes or T-bonds, right? T-bills or treasury bills, they are short-term debt. Short-term debt because they have original maturity of 1 year or less, okay? So if our federal government needs to borrow money for 1 year or less, it will issue treasury bills. But what if our federal government needs to borrow money for longer than a year? Then it will issue T-bonds or T-notes. Okay, treasury bonds or treasury notes. So treasury notes usually will have original maturity of 1 to 10 years. Okay, while bonds will typically have original maturity of longer than 10 years. Okay, so for simplification purposes, we typically just use 1 year T-bill rate as the risk-free rate on our exams in most cases. However, in practice, we need to be a little bit more cautious and more precise than that, okay? So in practice, most projects are long-term projects, right? Capital budgeting decisions are long-term decisions because if you are trying to evaluate a short-term project, it is called net working capital decision, not capital budgeting, okay? So while the yield curve is, I put those two words in quotation because it's just, that's true, only in general, okay? So it's not 100% positive, but yield curve is typically positive. So what is yield curve? Yield curve examines the relationship between the two variables, between time to maturity and yield to maturity. Well, this yield to maturity is what? Your RD, okay, your required return. The yield to maturity is the required return demanded by your bondholders. If you want to look at the yield curve graphically, the x-axis is time to maturity, which is T, okay? So we'll have the asset that's going to mature in 1 year, the bond that's going to mature in 2 years, in 3 years, in 4 years, etc. Okay, that's your x-axis. X-axis is the time to maturity, which is notated by T. Well, your axis is yield to maturity, which is notated by, well, basically required return, right? So it's notated by R. So typically yield curve, it has positive slope. So it looks like this. And that is because it is human nature that we don't like long-term commitment. Okay, we're afraid of long-term commitment. So while all else being equal, okay, if we're comparing multiple assets that have similar level of risk, while one investment has longer time to maturity, therefore it demands longer commitment, then while all else being equal, will demand higher rate of return on this investment that has longer time to maturity. Okay, so this is while all else being equal. Okay, investments with longer time to maturity should have higher rate of return. Okay, because human nature does not like long-term commitment. Okay, so usually yield curve will have a positive slope like that. Okay, it doesn't have to be a perfectly straight line, but you will have some sort of positive slope. Now, I use the words in general because it doesn't have to be positive. okay? Especially when we're going through some sort of crisis. It could be economic crisis like recession, it could be political crisis. So the bottom line is that something really risky is going on, something really bad is going on right now. So in the short term, in the next year or two, high risk, and therefore we demand higher return on short-term investments, short-term investments. But eventually, that whatever recession or that risk will be resolved. Okay, when risk goes down in the long term, a few years down the road, the required rate of return will go down. Okay, so the yield curve can be a negative, but usually a negative yield curve indicates something really bad is happening right now. If it has not happened, it is going to happen soon. Okay, and typically a negative yield curve indicates that recession is approaching if it's not already here. Either way, it means something really bad is going on right now. Okay. And this negative yield curve is called inverted yield curve. Okay, inverted yield curve. Or you can say negative yield curve, that's fine. Okay. So now we know that's not just risk level that matters, right? The time to maturity also matters. So it's inappropriate to always use the 1-year T-bill as our risk-free rate. Okay, we need to consider the time to maturity. Okay. So specifically, what do we need to do? We need to make sure to match the life of the treasuries to the life of the project. So if we're evaluating a new project that is anticipated to last for 10 years, guess what? The treasuries that you need to use in the analysis should also have the life of 10 years. Okay, we need to match the life of the risk-free asset to the life of the project. Okay, to control for the length of, to control for the time to maturity. Okay, so do not always assume that we will always use 1-year T-bill as the risk-free rate. So if the project is anticipated to last for 10 years, we're going to use what? 10-year treasury bonds rate as the risk-free rate in the CAPM equation. Okay, so let's look at the next model, dividend models. Okay. So we have reviewed 3 dividend models in here. You also learned that in Finance 330. Okay, so the 3 dividend models that we learned are the first one, the easiest one, zero growth. Zero growth model. Model number 2 is constant growth. Right. Model number 3 is variable growth or supernormal growth. I'm going to call it variable growth, okay? Because it is shorter, okay? So I don't have to write as many words. So zero growth, constant growth versus variable growth models. Okay, there are 3 dividend models. So the authors use DDM. It just means dividend discount model. Okay, dividend discount model. So the dividend discount model is an alternative to the CAPM for calculating the company's cost of equity. So which one of the 3 is appropriate when estimating cost of equity? Well, it depends on what kind of dividend that you have been having, right, in the past. So again, we graph our annual dividends in the graph. So the x-axis is time, we can call it T, right? And y-axis is your annual dividend. So when you graph your historical annual dividends, if the graph looks like this, well, the dividend is always the same. That should be obvious that we're going to use the zero growth model, right? So in the past, we have been using those models to solve for P0. So for example, if we have zero growth model, P0 is calculated as the annual dividend divided by R. But now, since we're not estimating for the P0, we're estimating for cost of equity. So what we have to assume is that we're assuming this P0, the current stock price, is traded at the fair market value. Okay, but we know that as finance majors, we know that we don't have a perfectly efficient financial market, right? We only have a relatively efficient financial market, which means that the assets are not priced at the fair market value 100% of the time. Not 100% of the time, but only most of the time. But we have to assume that whatever the price it is now, it is priced at equilibrium. Okay, that's the assumption we have to be willing to make. So assuming that the P0 is priced at the equilibrium, we'll rearrange this equation to solve for implied required return. Implied, because the investors are not saying explicitly that I demand 9% rate of return per year, okay? So the investors are not explicitly stating what the required rate of return is, but we're assuming that this P0 is at the equilibrium. So we'll rearrange the equation to solve for this R implicitly, okay? So if the investors are willing to hold on to the stock, chances are they are happy with the required rate of return, whatever that may be. So how do we rearrange this equation to solve for the R? All we need to do is to exchange the R in the denominator with the P0 on the left. So we can say R equals to D divided by P0. Okay. Now, on the other hand, if you graph your annual dividends and your annual dividend graph looks like that, then you're probably going to use the constant growth equation, okay? So we're going to look at the numerical examples. Okay, so let's read this together first. So the dividend discount model is an alternative to the CAPM for calculating the company's cost of equity, but we do have 3 dividend models, okay? So which one is appropriate? Well, it depends on how the dividends are behaving. So the dividend discount model and CAPM are internally consistent, okay? But academics generally favor the CAPM equation, while companies seem to use CAPM more consistently. Okay, the truth is that CAPM, even though in the past 30 years, it has been proven to have very low adjusted R square, but it is still the most popular model in the corporate world. Okay, when it comes to estimating the cost of equity, it is the most popular model. We'll talk about why, okay? Because one of the reasons is because it is so simple to learn, it's simple to apply, okay? And also here's another reason. Well, 2 reasons. The CAPM, okay, CAPM explicitly adjusts for the risk. Which risk? Systematic risk, okay? It explicitly takes systematic risk into consideration when calculating for the cost of equity. So let me bring you that equation again, okay? So CAPM equation says the return of the asset or of the company equals to risk-free rate plus beta of that company multiplied by the market risk premium. The market risk premium is the return of the market portfolio minus the risk-free rate, right? So this beta is being used explicitly, okay? So it tells us the only risk that matters, according to CAPM, is the systematic risk. There's no other risk that matters. Total risk doesn't matter, unsystematic risk doesn't matter, default risk doesn't matter, okay? No other risk matters except systematic risk. And there are very few models out there that actually explicitly, take one risk measure and plug that into the equation in the calculation. Okay, but CAPM does that. Okay, it explicitly adjusts for systematic risk. So based on this equation, we can see that the higher the beta means higher risk. It will give us higher required return on the left-hand side. Higher beta, well, all else being equal, will give us higher R on the left. And one other reason that is so popular is that here, it can be used on companies that do not pay dividends, okay? So on the other hand, if you're trying to use one of the 3 dividend models, guess what? You can only use dividend models when the company actually pays regular dividends, okay? Well, a lot of high growth companies, because they need to reinvest all of their earnings in new projects, high growth companies generally don't even pay any dividends. In that case, dividend models are not applicable at all, okay? So while dividend models can only be used on companies that pay dividends regularly, okay? But CAPM doesn't have that restriction, okay? So let's try one of the dividend models. Let's see which one that we should apply, okay? So if the company pays dividends growing at a relatively constant rate, oops, are we running out of time? Ooh, 12:25. Okay, well, I guess we're out of time. So we'll have to continue with this calculation when we return on Wednesday.